5:34 on the clock this morning, and today the Federal Reserve expected to potentially cut interest rates. And it comes, though, with limited job market data due to the government shutdown.
Natalie Haddad joins us from the newsroom. Okay, Natalie, experts are on the fence about what this could do for the economy.
Certainly, and I think that's fair enough to say. The Federal Reserve has a dual mandate to keep inflation under control and to help the economy and employment stay strong. Right now, inflation remains high. We all know that, but it is steady. And job numbers, they've been slipping. That's why today many expect the Fed to cut interest rates. Now, market experts predict the Federal Reserve could lower its key interest rate from the current 4.25 to 4.50% range to as low as 3.75 to 4.25%. Now, some economists worry the Fed should hold off, though, because key economic reports are not being released due to the shutdown. So they are working with dated data. Now, the Fed typically cuts rates when the economy is slowing and it wants to stimulate demand. This would encourage more borrowing and spending. They also ease rates when inflation is cooling enough that higher rates are no longer needed to keep prices in check. Now, here is how this affects you. Your borrowing costs may go down over time, meaning new car loans, personal loans, and possibly mortgages could become slightly cheaper. And while a rate cut doesn't guarantee prices will drop right away, it does set the stage for lower borrowing costs across the economy in the months ahead. Now, on the flip side of all of this, saving accounts and other interest-bearing deposits could yield less, since banks tend to lower what they pay when the Fed cuts rates. Now, all of this comes as the government shutdown enters day 29 with no expected deal between congressional Republicans and Democrats in sight. Mark.
We will see what continues to happen. Thank you, Natalie.